Hi, welcome to Market Minute. Boy, the basketball sure has been a lot of fun. We're looking forward to the Final Four on Saturday. Love watching NC State play. They're a lot of fun to watch. We're here to focus on what's going on in the markets. The inflation numbers, in our opinion, last week were too hot. So the Fed's not going to be able to cut rates as inflation stays high like this. So the market's going to focus on the CPI report on April 10th. Boy, the rotation has been really nice lately. It was a really good quarter. We think either the market was going to correct or it was going to rotate, and it chose to rotate. That's real nice, but we're probably coming to the end of that. The inflation numbers. So the February numbers were recorded at 2.5% year over year. That's up from 2.4% in January, and on a month-to-month basis, 0.3. So on the PCE, which is the Fed's favored inflation indicator, if you annualize at 0.3, it comes out to 3.6% annualized inflation. We also had GDP coming out that's going to look pretty good as well, high rather, at roughly 2.8%, and we'll get that later in April. But if you combine the real GDP growth plus inflation, you're getting nominal GDP of around 6%. That's too high, which is going to push the 10-year Treasury and other long yields higher. So the markets aren't going to be able to deal with a higher yield on the bond market for too long. The current PE is roughly 21 and a half times on the S&P. The median PE of 17.6 is a little bit on the high side now after we've had this nice run in the markets. So we think the median PE, so everything besides technology, more or less, is getting up there. So we need to get good inflation numbers, otherwise it's going to be a problem for the stock market. At this point, we don't see three rate cuts happening by the Federal Reserve this year. So things have to cool off for that to happen. Now, the market's going to focus in a big way on April 10th when CPI is reported. The rotation has been strong. As you probably know, Apple has faded a little bit, down about 13% from the high of the first quarter. Tesla off about 30% for the quarter. So some of that money is coming into the other sectors of the market, and it's driving those sectors up in a nice way. So if you look at the sectors that have been doing well, energy is actually the second best performing sector behind the communication services, which is the obvious names of Amazon and Meta and Google. The energy sector has been performing well, followed by the financials, industrials, healthcare, materials. So generally the market's been reasonably good, except for the real estate sector, which is more interest rate dependent, and maybe there's some credit concerns as to what's happening in the real estate market itself. We think we're getting kind of towards the end of this rotation. That's what needs to drive the market, in our opinion, at this point. So the technology sector's probably run a little bit too much. We needed the rotation. The rotation's happening, and the market's a little bit more vulnerable to a correction if rates start to drift higher. Now, the technicals, this is the S&P 500 from the bottom in late October to current. It's been, generally a parabolic move up, much stronger than we expected. We thought it was going to flatten out as we entered the first quarter. We had the couple of false declines here as it broke the 20-day moving averages, but it's continued up strongly as that rotation kicked in. So looking at other sorts of indicators, I think this is an interesting indicator, the Citigroup Panic Euphoria model, which takes into account a number of different things, such as valuations and where the sentiment is for the overall markets. So it's indicating euphoria at this point, and you don't see it here very often at this high level. So we think that this is a good indicator, not necessarily short term, but a good indicator, maybe 6 to 12 months out of what the market's going to do. Our view of the market is it's going to take maybe some time for this correction to kick in. Not sure how long. Maybe it's a week or maybe it's 6 months. But this huge bullish sentiment is kind of wear off. The Bulls are 2-1 versus the Bears. It's been that way for a couple months now, and it's probably getting to an extreme. So we think because of that rotation, the pressure on interest rates, perhaps that the market is a little bit more vulnerable to a correction occurring, or perhaps even a bear market later this year. So again, we're focused on that the CPI to be reported on April 10th, and then GDP to be reported on the 25th. And both of those have to come in a little softer. Otherwise, the market's not going to like it, and bond yields are going to go back up, and will cause evaluation problems for the overall market. Thank you, and just keep in mind, you should be somewhat aware that a correction of maybe a sizable correction could occur, but just be ready for it. We are well prepared for this to happen and to protect our portfolios. Thank you. Take care, and come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. We'll send that to you every Tuesday.